Hey guys, welcome to the Money Mindset. Today I have someone who I've been waiting to get on the show. Kenneth Andrade needs no introduction, but he's the founder and CIO of Old Bridge Asset Management, one of the pioneers of midcap investing in India. Kenneth has, I think, 30 years of experience in portfolio management and investment research. In his earlier stint at IDFC AMC, Kenneth delivered a compounded growth rate of over 22% over the 10-year period in one of his funds as CIO in IDFC AMC. So he's joining us here to talk about the market. He also calls himself a serious investor, but he has a very high sense of humor. So we're going to talk about all of that. Kenneth, thank you for being with us on the show.
Lovely to be here, Sonia.
You come across as a serious investor, but you're actually quite lighthearted, I must say.
Really, you're the only one who's told me that.
I've been interacting with you for the last half an hour and you're anything but serious.
Okay, tell me more. All right.
You tell me, how has the market been for you so far?
Okay, the journey in the last 30 years has been rewarding. There've been super normal changes that have taken place right through 30 plus years of me starting off in 1990 and to where we are right now. So I think I'm very excited about what's going to happen over the next 10 years, right? There are a lot of changes that are happening and people are really living in this moment of time. But I think to 2035, if you take a distant lens from today, things will be dramatically different. And I think it'll be much better than what we feel about it today. So markets today, a lot of uncertainty out there. I think we will pass the hump in 2027, 28. Until then, it's going to be quiet. I'm not very worried about losing capital in this market cycle, especially in the country that we are in, because we already come through the rough. We already come through the rough. So maybe it's just a time correction that you're looking at, and post that, life should be quite easy.
I don't think I've heard anyone say I'm very excited about the next 10 years because the way AI is playing out, the way everything's happening around the world, it is looking like kind of like a doomsday scenario. But is that just optics? Do you think things are very different on the ground?
So it's very topical, which is why everyone wants to know what's going to happen. And frankly, no one knows what's going to happen, right? We've had multiple scenarios in the last 30 years, and every time we had those multiple scenarios that take place, we all said this time it is different, but it's not. I think we've adapted, we've lived on, and we moved. We've moved with technology that was there and with technology advancements that have come into place. So let's look at this as a pause in time. Okay, things will fall into place. We will adapt and we will adapt very fast. And
How can you be so sure?
uh, you've seen it in history. I think just go back to the entire 1900s and see where we've come from, right? And look at the human species before that and how we've evolved to where we are. So this is just a stage of evolution, and I guess we will know for sure in 10 years. Okay, but we're living through this entire cycle. So I think we just have to enjoy this moment in time, and and it, and people. I'm pretty much sure this entire world will adapt. See, one thing that we've been missing for a very long period of time, and this was since the 2010s, was a investment cycle that was completely missing. You got that investment cycle down. Okay, you got an investment cycle coming back, but it's in a very different industry that we've never known nothing about. So I guess that's what's the most interesting part of this is what are the ancillaries of all of this? What's really going to do well? How are developing countries going to adapt? Will there be a developing country ever going to be a developed country again? Is that the opportunity, or will the world's largest economy continue to remain the world's largest economy in perpetuity? Okay, those are the answers we don't have because it's never happened before. But 2025 to 2035, I think you'll see some reasonably large shifts that are there. How we stand as an economy, as a country, um, I think we'll still be around. If we can find the if we can find the roadmap which adapts into changing world, I'm pretty much sure we've earned the right to be in the top or remain in the top five, if not the top three, in perpetuity.
But there's one argument as well, right, Kenneth, that humans over time won't be needed anymore. Everything's going to be done by AI. And at this point in time, AI is just developing new AI. So it's like pretty much like if we are in a situation where humans are not only losing their jobs, losing their vocations, and then that has a snowball effect into many things, right? Consumption, demand, eventual industries falling apart. How would you assess all of that?
Extens. This is an existential crisis, right? But relook at it all over again. If you look at the fertility rate that's happening all over the world, okay, that's in a decline. Populations post 1950 will be on a decline completely. And how do we keep the legacy of what's happened over the last, say, 150, 200 years still alive going forward? So this is just a roadmap on keeping everything alive and keep going out there. There's always been a segment of the economy or a segment of population that's always been left behind. I think in this case also that will continue to happen. So it's a little bit about evolution, and if and I don't think automation or artificial intelligence is a doomsday scenario. A doomsday scenario is when your population stops growing and actually starts declining, and I think that's the biggest problem that uh, us, not us as a country, but us as a species is facing. So this will just adapt, it'll merge, and you'll find your opportunities as it goes forward.
So, just to complete this argument, if this is the doomsday scenario that we're looking at, where the population will eventually start to decline and growth stops entirely, what do you think the next 10 years will look like?
Step back. Let's not talk about all of this because I don't know.
Okay, and neither do
Okay.
I. And if you don't know, then I definitely don't know.
We all have to build scenarios into how we have to reimagine these spaces that we work in will be, and these are not, it's not just for you and not just for me, but every individual, and then and build and and build, I won't say survival, and grow out of those problems. Okay.
So let's talk about what we know, which is the
Yes, perfect.
markets.
Super. Now you're getting me back.
No, this is, but it's still a market where nobody knows, right? If we go back in what happened in COVID, everyone thought the same situation was sort of playing out, right? End of the world situation, and what does one do? Everyone was selling. This is a market which has not given returns to shareholders for many years now, about 1.5, 2 years. What is your market view at the moment? Do you think that we are towards the end of a time correction? Do you think that there could be more to go?
Now this is where things are very simple. See, in COVID, everyone knew what to do. You got stocks extremely cheap, and it was an opportunity in a lifetime. Things were at 2.5 times earnings and 3 times earnings and 5 times earnings. And I think for those who didn't capture that opportunity, you'll have to wait a little while before you get it again. Right. But right now where we are, there is nothing to panic about. If it's a year and a half without return, the bad news is you have to wait another 1 year. Okay. And I think that's when things will start to ease out a bit. So we've been struggling. Corporate India has been struggling with one simple thing, is growth. Okay. And growth seems to be a genuine issue of coming back. That also came from the fact that we haven't invested enough. Corporate India hasn't invested enough into capex and building capacities, and we're stuck in that zone. So a couple of things that are happening on the ground. Okay, and let me talk about industries that are doing well and what they are doing there. So it's not about I like this industry, I don't like this industry, but when an industry does well, it puts capital to use, right? When it puts capital to use, capacities come up. But if capacities are coming up and you don't have a market to sell into, what do you do? Okay. Now, one of my favorite topics in the last couple of months or couple of quarters has been automotives, right? So you've seen what India has done with two-wheelers, right? We become the place to go when it comes to personal commute on the two-wheeler side. We are becoming the place to go when it comes to the four-wheeler market right now.
Globally.
Yes. Okay.
Don't you think China is doing it far better, especially in like segments like EVs?
That's exactly why India is taking the second place to it. It's a market that got vacated. which is the ICE engine, and we've come through as the lowest cost producer of those vehicles on the ground. Add a hybrid to it, and we're right up there in terms of capabilities, capacities, and costs. Okay, so whatever the Chinese are doing, I don't want to get into trying to understand what the Chinese cost dynamics are, but we manufacture the cheapest automobile in the world. Okay, if you look at India's largest car manufacturer and look at its average realization per car, which is 7,20,000 rupees, no one does it at 2.4 million cars per annum. No one in the world does it, and not at that scale. So there's something that happened out there. Okay, IT, we know the story and we know what's happening on the other side too. In pharmaceuticals, we know what's happened in terms of how some of India's generic companies are the largest in the world and dominant in the US, which is the marketplace that is there. Okay, in solar modules, we know where we are. We stand number 2 in the world after the Chinese, right? And we don't know where to sell the modules if the US clamps down on these modules. Of course, we know where the markets are, but that's pushing us to be significantly more efficient than we've done before. The difference between the world today in India in 2025 to any time in the past, okay, is we've got scale. Okay, to find low cost manufacturing without scale just didn't happen. So the Indian economy actually exploded. We've got scale in our domestic market. We manufactured a large number of products and spread the fixed cost just in the domestic market. Now, every incremental product that we sell out of that into newer markets, we are significantly more competitive. Okay, and that's the transition that we've taken from the turn of the century to where we are. Now, this is important also because when we open up the rest of the world for all these industries, that we have surplus capacities with, we find what we've been missing in the domestic market, which is growth, newer markets. Okay, and I think that's the way it goes. The Chinese did it. The Chinese didn't become the world's second largest economy by having an insular growth. They had to build capabilities to take market share from the rest of the world. You step back, the Koreans did it the same way. Okay, and you step back further, the Japanese did it the same way, and if you step back, the Americans did it the same way. So I don't know if this business or this economic model is going to be very different from now, given that we talk trade barriers across the world. But I'm sure we will find a way to move into with some industries to dominate verticals across the world, irrespective of trade barriers. But this is all what I tend to see is something that you have to map out individually, industry by industry, to see how far we go. So I think that's the world we're getting into from our country specific. We are a little late in the cycle for automation. When I say automation, is the artificial intelligence that's the topic today. But we can still make all of that work for us. We can be a late cycle player in all of this and enhance our productivity even more. Okay.
So if you let's take it one by one, right? You spoke about IT. I noticed that in your fund you had one IT stock, HCL Tech, and now you've sold that as well. So you've kind of thrown in the towel when it comes to tech, and I understand why, because of AI. But you tell me, what was your rationale? Do you think that the tech story is over from an investor POV?
Not at all. So let me give you some sense of what went through our minds when we took that decision. Right? We don't know what's happening. Okay, will we know it in the next month? No. Will we know it in the next quarter? Maybe. Will we know it in 6 months? Again, maybe. So the entire thing is, where do you start? So when you have a position, you're there. When you have no position, you have to rethink whether you'll do it again. And if I had to build a portfolio today, I'd build it without that till the dust settles. Right? And that's a call we took on the name. So we stepped back a little. We went to zero on that position, and then we will rethink what we want to do. We will definitely have a company from that industry in our portfolio. We'll definitely have that. Whether it's going to be in 6 months or 1 year, I don't know. Will we have the same name? Maybe. Will we have another name? Maybe. But it's not that you write off everything. You just have to try and figure out what are the long term challenges that this business has. See if the managements are capable of addressing those long term challenges. And in all this chaos, I'm pretty much sure valuations will be lower than where they are today. All right. So we are heading in that direction. In short, if I'm a financial analyst and to rethink this, the terminal value of that business is falling. Okay, if the terminal value of that business is falling, it has to show up in my upfront valuations, and I think that's what the industry is all about today.
So you don't know, you don't have any clarity, so you're taking a step back and moving out of the space. When you get more clarity on which way things are headed, then you may take a call again.
So I tend to believe that investors give us money to manage, okay, and put money to work in things we know, right? And I'm not going to second guess the market that we know better than what the rest of the industry knows. So we took a step back. We'll rethink this position, and we'll take a look at what we want to do.
So, for all those investors, and I ask this question to every guest who comes on my show, right? For all those investors who've recently entered the market, who haven't seen too many bear markets, and post 2020, we saw a huge crop of young investors who entered the markets and now are seeing no returns for 2, 3 years. What's your advice to them?
Well, these are just tuition fees, right? So look, I come from a vintage of the 90s. 90s rarely made money. If there was anything called making money, it was a nice cycle to be in. There was lots to learn, but there was very little money to make, right? And that's what shapes investors.
That's because you were a journalist. Journalists don't make money.
Maybe now that you think about it. So I think so. A lot of investors, and my investment team has got an average age below 30. None of them has seen a cycle. Uh, it's normal to believe that 20 times multiple is cheap. Okay, it's normal. Okay, and I've seen very different. I mean, anyone from my generation has seen things very differently. So for anyone getting into a market cycle, I just think that you investing is more about patience and discipline than about being smart. Okay, and you'll have to go through a couple of these cycles. You have to see a full cycle, and you can't see an up cycle and think that you've taken the right decision. So you'll have to wait for a decade and a half before you can even call yourself an investor.
Even mutual fund investors.
Mutual fund investors are okay. But mutual fund investors put money into diversification. So we are a diversified pool of assets that that an investor holds. But if you look at individual investors who invest in stocks, this is a long cycle for them. For a mutual fund investor over a period of time, this is a cycle where they need to accept the fact that 15% return that the industry promises them,
It's
okay,
not going to come.
is not linear. It's not linear. Uh, it will be around in some format, but it is not linear. So a year or two of a pause is better than 30% every year, because when you do that, then you tend to invest on the top of the cycle with more money than you have, and that corrects your that corrects your long term returns. So this is a nice cycle to be in. I think for investors who started investing for the last 2 years, they're probably going to emerge as the best with the best IRRs ever compared to investors who've been there for the last 4 years or 5 years.
Oh, really?
Yes, because you've been investing in an up cycle, right?
Yeah, yeah.
Okay, and the more you invest in a down cycle, the better it is for long term returns.
So you're saying this is the start of a longer down cycle?
Uh, I'm not worried about losing capital. It's just a time correction.
Okay. No major crash expected. I mean, nobody can time it. Nobody can predict that, but
Unless there's a large event out there, there's no crash coming. Okay, and I can say this quantitatively, putting numbers together. Corporate India is in the best financial position it's ever been. Okay, balance sheets are not going to blow up. There is some element of crisis which is still there sitting in the small caps out there. So that market is still only 15, maybe 20% investable. But from a market capitalization standpoint, you're not going to see 20% of your capital evaporate. No. So if if you're working with a pretty well diversified portfolio, no risk.
So it's interesting that you have you have a focused fund which has been on for a while, but you've also now launched a Flexicap fund. And the common, I think, complaint, I don't know if you've received complaints, but that's what I see online, is that why would you want to launch a Flexicap fund when you already have a focused fund? What's the difference between the two? What would your answer be to that?
Well, I wish I could run with just one product in perpetuity, right? But the position that we've taken with the focus fund is that so a little bit of genesis about Old Bridge and how far we've come out here. We used to run a portfolio management product and AIF along with a couple of advisories, and we used to run between 20 to 25 names out there. So focus was just an extension of what we did in the AIFs, the portfolio management and advisory. And when we put a mutual fund together, it represented everything that we've done in the past. So it's the same portfolio. Okay, so we've been working with our investors on the alternatives business, which is the AIF and the PMS, to move their money to the mutual fund because it's a very tax efficient structure. So what you're getting out there is a 10-year portfolio which is already been has a track record, and we transitioned into a focus fund. The problem with 23 companies is it sounds nice on the upside, but there is a reasonable amount of seasonality that comes with it. Seasonality because you're very concentrated. Our largest position is 9% of our portfolio. Our second largest position is about 7% of our portfolio.
In the focused fund?
In the focus fund. And if anything happens to these names, which usually do, okay, you get volatility in the middle. Okay, and that's something that a normal investor or a new investor in the marketplace would find it difficult to reconcile with. So the need for a product which is a flexi fund. I am not constrained by the number of companies, and the way we approach is that you have 35 names. Okay, the diversification or the breadth of the portfolio, the denominator of the portfolio, will take care of that seasonality and volatility. Okay, so destination is the same. Ideation is the same.
Is stock picking different?
It it is the same. Okay, the only thing is that I think need to contain a bit of volatility that is there. So Flexicap is nothing but an extension of our entire thought process on how to build portfolios. One will be focused. It'll be early cycle investing in the markets. In Flexicap, we'll accommodate a little late cycle plays also in it. But thought process of investing is exactly the same. So to just add on to it and make it a little more boring, and I'll use
I'm
financial
sure it's not
metrics.
boring for investors who are invested in your fund, because these are questions you get asked a lot.
So just a sense. So you'll never see us being underweight in one fund and overweight in the same sector in another fund.
Got it.
Okay, so if we like pharmaceuticals, it's 12.5% of our portfolio. It will definitely be more than 6% of the benchmark in the Flexicap fund. So it will be between 6% and 12% in the Flexicap fund. If you've got 12% or 12.5% in financials or in the lending business, it will be closer to 20%. We won't be the indices in the indices you have the 30% weightage. So I think the difference is incremental. It is not stark. The destination is the same. Both products will reach there at different times, but the journey is the same.
Okay. You spoke about, the lending business, lenders. Shriram Finance is actually one of your biggest holdings in your focus fund. Not getting into individual stocks, but just want to talk about the NBFC space a bit. What is the potential that you see? And considering it's such a big part of your holding, I'm sure you have a massive positive view on it. But if you can take us through your view.
Uh, so it's been with us for a while now. So it's not new. And a large part of that large weightage has come because of mark-to-market gains that it's had. So it's had a superlative quarter for the transaction that has come through. But it's not the only company that's went through a transaction, right? So when something like this comes in, so just to give you just to put the numbers in place, on a 60,000 crores of net worth, this company got 40,000 crores of fresh equity flows. Now, when a capital structure changes that dramatically, it's a new business altogether. Now you have to look at this company with a slightly different lens, or that's our perception. You have to look at it with a slightly different lens. First, 40,000 crores of incremental numbers, money that comes in. If it's a steady state business, if that business doesn't have to grow, he'll just substitute his debt, right? So if I'm have 40,000 crores and I'm paying 8% on that debt, that 8% becomes profitability for me. So take debt out 8% and replace it with equity at 8%. You get 3,200 crores of additional profits. Okay, 3,200 crores of incremental profits is big for any kind of business. Okay, and especially for this one, because he runs a PBT of about 12,000 crores, and you can do the math. Uh, and if that's the case of this company, you can his historical leverage has been 5x. Okay, so you multiply that by 5, and that's the amount of capacity he's now building. Now he has to go and find a market for that.
India is a big enough market for it.
Oh, you'll be surprised how small it is.
Really?
But yeah, it's a market which is there, and see, the lending business is a fairly simple. It's a fairly, I won't say a simple business. Collections is a very difficult business, but giving money to people is the simplest business you want to be in. Okay, it's just the collection part of it that you need to have efficiencies, and that's where the NBFC spaces come in. They are reasonably good at their collection efficiencies are reasonably high, and their ability to and that's their USP. That's been their USP since the beginning. The banking system assesses credit well, and non-banking financial company can manage recoveries pretty well, and that's the differential between the two. So I tend to like this space because they can find growth markets. Okay, and now in this case, some of these names that are there on the side have fixed their liability side, because this is not the only transaction that has happened in the last year. The multiple transactions have happened. So that's a little bit of a narrative around this one name or the space around this space. If you can fix your liability side, I think these companies should or this category or these companies should be good.
Okay, okay. That's on NBFCs. The other big holding that you have is in Aurobindo Pharma. So I want to talk a little bit about pharmaceuticals. I was having this conversation just a while back with someone who spoke about the huge potential that pharmaceuticals has in spaces like hospitals, for example, CDMO. But a lot of these have played out, right? So at what stage of the cycle are we in? Have we already reached a mature stage?
Uh, So in manufacturing, definitely. So we've got enormous amount of capacity that's sitting out there, but it's not about just manufacturing capacities, but it's also compliances on manufacturing that you have, and of course the CDMO or the R&D that you do. But key to all of this is the marketplace that is opened out, right? So if you remember in 2014 and 2015, which was the first time most of these companies came up on the radar, this was the first patent peak that we had. Okay, number of drugs going off patent. This is the second one that we have. Okay, there's almost $700 billion worth of drugs between 2025 to 2035 going off patent. And a lot of these drugs are in large molecules, and some of them are in small molecules also. But this is the target market. So there's a defined target market out there. Okay, the change that is there right now is that almost the competitive intensity today is far higher than it was in 2014 and 15. Okay, so companies have to redefine their business models for the cash flows that they've been generating, and I think that's undergoing a transition right now. So it's nice to see a business and what we tend to follow. So if Shriram is putting capital to work freshly, right, this company has also got a massive buildup of capacities that is there on the ground. So somewhere, whether it's number one, number two, number three, number four, or you can go down the portfolio. Most of our portfolio companies are investing close to 100% of their existing capital, existing invested capital. They're putting it to work. Either they have put it to work for the last 3 years, or they're putting it to work in the next 3 years. So what we're trying to do is follow the money, follow what entrepreneurs are doing and what capacities they're putting out there. Pharma is one of those industries that are doing that. There you can actually identify the industry size or the opportunity size that is out there. So CDMO, generics, etc. They're all nomenclatures to the same to the same industry, to the same target market. So, but that's one space that we think is exciting enough for us to have it as the second largest holding.
Yeah, it's second largest holding in your portfolio. Okay. Well, just one more criticism that the market has about your focused fund, right? If you look at, of course, you can't compare 1 year's performance. 1 year's too short a time. But if you look at the last 1 year, your focused fund has given returns of around 15%, but it's underperformed the market. So if you look at, other funds, SBI, HDFC, Flexicap, etc., have all given in the range of around 17 to 20%. What would your response be to that criticism?
Okay, if I'm coming three in a field of the larger funds out there, I'm not doing very badly, so it's fine. But I think it's a cyclical play that has come through. Those are funds with a long legacy that is out there. I've got 2 years since performance, 2 years since we've incorporated the focused equity fund and we've put it together. It's built up a 2 year track record, and if I can't highlight my 10 year track record because the other 8 years is with my alternatives. But in 2 years, if I'm at 12.5, 13% CAGR, I've done a pretty okay job. Now, the thing with managing money, and I've seen this historically, is that you have to wait your place and time. You just have to keep your head over shoulders. There will be one 6 month period or 1 year period where things will all fall in place, together. And I think that's where that's what we'll just have to wait on the outside for. Is our structure very different from everyone else in terms of sizing? No. In terms of portfolio construction, we are completely the opposite. Okay, we are much more a stock pickers fund out there. Okay, when I say a stock pickers fund, you take the three names. The probability of those three names being in the top 10 of any fund in the country is not there.
Yeah.
It's not there. Okay, and there are reasons why we're holding all of these three names, and all these three names have been with us for a while. Okay, so probably of the three or four large names, except for one company which is Shriram, which is at its all-time high, the other three haven't done anything yet.
No, they haven't. Yeah. I mean, that was my next question to you. Whether you look at, Reddington or Rubindo, if you look at the last 5 year period, there's really not much that these stocks have done.
Exactly.
So, I mean, and there's a huge opportunity cost also, right? People would come with this argument that I'd rather invest in, say, gold than invest in funds that have done nothing with their top holdings. That is an argument that people have.
But it's still 12% CAGR over the last 2 years. Okay, but that's the holding cost that you have. So you've been paid to hold these businesses, and if the cycle falls, if the cycle gets back into their favor, I think we should be okay in 2026 and maybe even 2027.
So just to wind up, Kenneth, yours and of course the entire fund management industry, it's a very tough job, right? Managing other people's money, being a custodian of other people's wealth. How do you manage the stress of managing other people's money?
Well, we are amongst the largest investors in our own fund. Okay, and I can say that because we are. And if that's the case, I'm managing my own pool of assets too. So, am I doing everything that I would do for my own capital that's there? I am doing exactly that. So the stress doesn't. So so for me it's a hobby turned career, and this is the only thing that I know how to do. Okay, so there's a little bit of, I would say, concern when you're not doing well, but when you're doing well, you're supposed to be doing well. So I don't think there's so much of stress that comes with it. Yes, there's an expectation level that the investors do have, and we try to meet those expectation levels. Right. In the last 20 years, when I look at my career in public markets, the track records are out there. We're fairly out there in the top decile, if I can say, if not in the top percentile in terms of performance. I'm sure the question you asked me about your number 3 in a category that exists, I'm sure we'll wait into 2026-27 and see how that works.
So, what are the behavioral changes that you have made or one needs to have made over, say, a 10-15 year period to sustain this kind of career, legacy, reputation, temperament?
I can see one thing. See, I'm on the wrong side of 55. Okay, it shows. Okay, and I think the only one thing that I've learned in all of this is you got to stop making the same mistakes again and again, right? And you got to definitely make sure that you've done your homework before you allocated capital to a business. I think that comes naturally to me, which is why now, and not so much earlier, because now our portfolio churns are down to about 10%, if not, I mean, at max it's about 15%. That is, in the last 2 years of managing the focused equity fund, we've had only 6 names that have gone out of our portfolio. Okay, so I think that's where
Reducing your churn.
that's where the big change comes from. Of course, with a mutual fund, the advantage is that you don't pay tax every time you churn. But in the alternatives business and in the AIF and in the advisory, my clients always told me my biggest cost is taxation. My biggest cost is taxation, it's not fees. My biggest cost is taxation. So the lower you have your churn, the better it is for the end investor. Okay, because no one in the alternatives, except for the AI, Cat 3 AIs, no one in the alternatives disclose their portfolio returns post tax. I think that's what some material change will be between one portfolio manager versus the other portfolio manager, and I think that's what comes naturally to myself. And now I hope the team also has learned, has caught on to this. Get your stock right before you invest in it. Okay, because it's going to live with you for a while.
The good and the bad. So, if you had to end the show with, one or two learnings from your 30-year long career in the market or 30-year long investing journey.
Don't make it sound like a punishment.
It's the truth. I'm just stating a fact. No, I mean, it's been a great, glorious career. If you want me to call it that, it is what it is. I mean, the records are out there to see, right? But what would your biggest learning be?
I think there's so many on the way, but I'm just fortunate to be in an industry where you go to office everywhere and you learn. You go back to your work and you learn multiple things. I think that's the biggest learning that I have. So you never stop doing that, because the day you think you know everything is the day you'll make your biggest mistake. Okay, I think that's the journey that there is. So for all of those who've got into who've got into investing over the last 5 years, okay, it's just the start of a very long process. Process it is. It's not okay, and there will be multiple cycles. Most of the cycles you won't like, but that's the time where things get better.
So you don't fear that AI has become kind of a leveler, right, for everyone. I mean, the kind of research and access that you have to data is available to me as well in the click of a button now. You don't fear that that could make people like you redundant?
Um, if it does, it's good for me. I'll give AI to manage my money. Okay, so there's pros and cons to it. I think the 90s, it was a very different generation of investing. The 2000s were a very different generation of investing, because that time you had information access over the internet and the internet was established. Today someone does the research for you, so you get an output also of whatever input that you give it. But the key to all of this is that how do you interpret data? How do you interpret recommendations? Okay, you can get information at a click of the button. The key to all of this is interpretation. I think that was true in 2000, in the 90s. That's true even today. Okay, and by the way, with automation or with AI, or without AI, 85% of only 15% of managers manage to outperform the passive funds globally. Okay, uh, So it's already in
So you're saying
some form
passive
or
investing
substance.
is still better than active investing?
In some form and substance, that's already taken
It's
place.
already happened, yeah.
Okay. Now the active investors have to have a chance to increase their probability of beating the passives, and there are tools out there that you could use, or you could help it adapt to the next decade or two.
Wow. We'll see. We'll see what happens in the due course of time. But Kenneth, thank you so much. We've run out of time, but thank you so, so much for joining us on the show. And it was a pleasure speaking to you.
Likewise, Sonia. Thanks for inviting me across. It was lovely having this chat.
Thank you. Thank you so much, guys, for watching.